Hey everybody, welcome back to the channel. Today I'm going to be doing an overview and analysis of Kinder Morgan. This came from a subscriber request, so if you like what you see and you want to submit a request, please leave a comment and I'll make sure I include it in a future video. So we're going to talk about Kinder Morgan today, and it's in the sector of energy. It's an oil and gas midstream company. As you see, it was founded in 1936, and it has four different major product lines: natural gas pipelines, products pipelines, terminals, and CO2 storage and pipeline. It has about a little over 10,000 employees, and they're headquartered in Houston, Texas. As you see on the screen, they have pipelines throughout the United States. So let's look at a little bit more about Kinder Morgan. This is directly from the company themselves. They say they're the largest energy infrastructure company in the S&P 500, and about 67% of their cash flows come from what they call take or pay or hedge earnings. Take or pay means that the people who buy their oil and different things from their pipeline either have to take delivery of the oil or pay. So either way, the company makes money. They do say they have a strong balance sheet and attractive returns on their growth projects. The current yield is around 6.4%, and according to the company, they have a healthy dividend coverage. We are going to be talking about that later in today, and we'll do our own analysis. They do say they have a top 10 dividend yield in the S&P 500, so for those who like a higher yielding stock, this might be a good choice. And they did a 1.73 billion share repurchase program that is still remaining out there. It does say that there's ownership within the management team, so that's usually a good sign. So we're going to go into more further detail on this company, see what they're all about, see what they do, check out their financials, do some valuation metrics, and of course, look at the dividend because, we're dividend investors. So Kinder Morgan Inc., ticker is KMI. The price as of yesterday was $17.21, and the 52-week range is $16 to $19.36, and they have a little over $38 billion market cap. So let's look into what they do. So according to the company, they have 82,000 miles of pipeline, 140 terminals that store and handle their different products, and about 40% of the natural gas produced in the United States is transported through their pipelines. Going a little bit more in depth in the business lines, their natural gas and products pipelines, they have 82,000 miles of pipelines carrying natural gas, gasoline, crude oil, and carbon dioxide. Their terminals store and handle gasoline, diesel fuel, jet fuel, chemicals, metals, petroleum, and ethanol, and other renewable fuels and feedstocks. They have 140 throughout the United States. They also do natural gas storage, and they have 700 billion cubic feet of natural gas storage capacity. And they also generate natural gas with approximately 3.8 billion cubic feet per year, with an additional 3.1 in development. So quite a diverse set of line of business, all within the pipeline industry. So some future opportunities that they list on their website is their lower carbon initiatives. So when you think of oil and gas, you think of, bad for the environment, polluting, but they are looking for opportunities to lower their carbon footprint. And they're going to be doing that through carbon capture and sequestration, renewable natural gas capture, hydrogen production, renewable energy generation, electric transmission, and renewable diesel production. So they're going to try and implement greener alternatives to their traditional business. So hopefully that will allow them to compete in the future with the upcoming transition from oil-based to renewable-based energy supplies. But in the meantime, they still do have their traditional business lines to help support the business. So let's look at some of their financials. Looking at the income statement over the last few years, you can see that revenue has generally gone up, and the earnings per share has gone up as well. This is a very cyclical business, as you see from in 2020. Their earnings per share were very minimal, and then they've increased since then. The balance sheet, again, is relatively stable. Their assets have been stable over the last few years. Their debt has stayed stable and is actually on the decrease. And so they are doing a pretty good job managing their balance sheet. And the cash flow statement is kind of all over the place, which makes sense for a cyclical business. You see the free cash flow in 2020 was 2,843, then went up to 4,427, and then down to 3,346. So it is all over the place, but that does make sense based on the business they're in. If more oil and different products are sent through their pipelines, they're going to make more money, and the cost of doing those transports are going to vary through year to year, so their free cash flow is going to vary as well. Free cash flow is very important when it comes to dividend safety, which we'll talk about later. So let's talk about a little bit about the dividend. So according to Seeking Alpha, the current dividend yield is 6.51%, which is an excellent yield. But the problem that you see on most of the financial websites is that it shows the payout ratio is relatively high. It's actually over 100% right now when you look at earnings. Their 5-year dividend growth rate is 11.5, so you might be wondering how can they afford to pay this dividend? Well, in a company like a pipeline company, you can't really look at earnings. You have to look at free cash flow to see if they have the funds available to pay the dividend. And it does say they've raised their dividend for the last 5 years. Looking at the historical dividend yield on the right, you can see that it has been averaging a little over 6% average yield over time. So it looks like it's pretty stable when it comes to the dividend payout. As I mentioned earlier, if you look at earnings per share dividend payout ratio, you're going to have percentages that are well over 100%. And if that was all we're working with, the dividend wouldn't be sustainable. They wouldn't be able to raise it. But in this particular case, if you look at the free cash flow payout ratio, you can see it's much better. So in 2020, it was 86.86%. 2021 is 57%. 2022 is almost 75%. And for the trailing 12 months, it's almost 76%. So when you look at it that way, there's plenty of funds left over for them to invest in the business. All right, so let's look at some valuation. So I calculated 4 different valuation metrics for Kinder Morgan. I did a price to earnings mean reversion, price to book mean reversion, price to free cash flow mean reversion, as well as dividend yield theory. All 4 metrics show that there is a slight discount on Kinder Morgan at this time, ranging from 2.4% undervalued to 8.06% undervalued. But generally speaking, I would say this is probably fairly valued. All right, so let's look at the stock performance over the last few years. As you can see, the performance has not been great. So Kinder Morgan over the last 10 years has returned a total of negative 23.49%, and that's including the dividend reinvested. Breaking that down, that's an average return of negative 2.64% each year for the last 10 years. When you compare that to other well-known dividend payers like SCHD or even the energy sector ETF XLE, it does not compare. So SCHD is up over 200% during that time, and XLE is up over 58% over that time. So in the past, KMI has not been a great investment, even with the high dividend that you're receiving. So looking at those metrics, the company seems very stable, predictable business. They are looking for a renewable future, but the overall returns that you're getting as this investment have not been great. The alternatives that you could pick have produced a much better return. So at this time, if it was in my portfolio, I would not be adding this particular company to my portfolio, but it's not to say it's not right for you. So please do your own due diligence, review the details of the financials and the outlook for the company, and make your determination for yourself. So thank you for watching, really appreciate it. If you do have other companies you want me to do a quick review on, please add a comment below, and I'll make sure to add it to the list for a future video. In the meantime, please visit our website at dividendstockpile.com, as we'll reach out on social media. We're on X as well as Threads. And while you're here, take a look at this next video being recommended. I look forward to seeing you in the next video.